All right. Welcome, everyone. Welcome to this episode of Market Wrap. I have with me Mr. Pankaj Pandey. And what a week this has been. We saw one of the most massive rallies of all times, be it in this week or in individual days. I think that was just astounding. So, what is happening? What did we see there? And what is likely to happen from here on?
Yeah, hi, good evening, Vishnu. Yes, this was one of those weeks which everyone is going to sort of remember for some time. So what we have seen is that Nifty gaining about 4 odd percent, which is again massive for a week. And the broader markets did even more better with about 7% kind of a gain there. We've sectors like defense, metals, real estate, all of them are doing phenomenally well. See, this is largely more to do with the sentiment that US and China have started talking, and there could be a further deal or a potential deal can happen. And that sort of drove risk on sentiment across markets, and which is why the markets have rallied. Volatility index or VIX sort of plunged about 22 odd percent. So that really sort of lifted the overall market sentiment. Now, what to sort of expect from here is that again, since we have seen a breakout of the market from say 23,200 kind of a level to 24,000 kind of a level, and we closed about 25,000 kind of a level. So this is a 3 week consolidation breakout which we have seen. So technically, our sense is that 25,500 is what we should watch out, or should be the level for the next week. And I think supports are placed at somewhere about 24,400. And we've seen mid cap and small cap sort of recovering pretty well. I think Nifty is only up 5% from its lifetime high, whereas mid cap and small cap is up is about 8 to 12% lower than its all-time high. And good part is that, or historically, we have seen that whenever, especially the broader market, the mid cap and small cap, whenever we see a correction to the tune of 27, 28 odd percent, and which lasts somewhere about 7 to 8 odd months. Typically, the next 12 months are equally productive, or 6 months are equally productive, fetching slightly higher than kind of a return. So, 28, 30% kind of a return is what we have historically seen. And what is also driving is that FIs have made a comeback into the market. And there is an interesting data also with respect to FI. So whenever FI selling in a particular quarter crosses, say, 30,000 crore plus, next subsequent 12 months have been pretty positive for markets. Like I said, the US-China deal, that has been sort of good. Then we've seen the dollar index or crude oil or 10-year bond yields, all have sort of become favorable. Market breadth has improved quite dramatically. So now you have 87% of the stocks in the Nifty 500, which are trading above 50-day moving average. And this number used to be about 27 odd percent during the month of April. So you're seeing a dramatic turnaround in the fortunes. So that way, I think all said, I'll not be surprised if in the coming months we are headed for a new high.
Absolutely. Sir, we also saw CPI numbers this week. What does the ticker look like?
Again, this is another macro positive for us, Vishu, because inflation came in at about 3.16%. Expectation was around 3.2%. And mind you, October 24, the inflation was about 6 odd percent. So literally, it has halved from those levels, and largely driven by food inflation, because food inflation that point of time used to be about 10, 11 odd percent. Now it is about 3 odd percent. And we are continuously seeing a degrowth in vegetables and other cereals. So that is sort of driving the inflation lower, but core inflation is at about 4 odd percent. Now, for us, the key implication is that for next three quarters, the inflation expectation is somewhere about 3.6 to 3.9, so under 4%. And our base expectation is also 4%. Now, if I have to sort of put that into number, currently the repo rate is about 6 odd percent. So our sense is that the Reserve Bank can easily cut the 75 bips of rate cut this year, because with 4% kind of inflation and a real positive rate of 1.25%, repo rate of 5.25% is very much possible. So 75 bips kind of a rate cut is positive news. We already have seen 50 bips kind of a rate cut. So from that perspective, and typically in a rate cut cycle, what happens is that the multiple sort of goes up. It is generally positive for the overall economy. Initially negative for banks, but in general, it has a positive rub-off. So I think with the rate cut cycle sitting in and getting better because monsoon projections are expected to be good. So I think we are domestically very well poised for lower interest rates.
Absolutely. And now let's talk about something that has been on everybody's mind. I think the defense sector, it has roared like anything. What has happened here, sir?
Not surprising because I think defense stocks have been in focus, and after the recent conflict between India and Pakistan, we've seen most of the defense stocks gaining in the range of say 15 to 35%. And I think what this conflict has proved that the Indian defense platforms are pretty good. And I think the country's focus is also going to be on strategic autonomy, self-reliance, and higher capital allocation. I think is more sort of a given. And I think if you sort of look at the recent comment from Defense Minister, now the focus is also on indigenization, innovation, and global leadership. And not only for securing our borders, but also to sort of position it as a key player in the international defense ecosystem. So I think defense overall is sort of shaping up well, and I'll sort of throw some data points. A period between say 2013 to 2022, acceptance of necessity was given to 8.5 lakh crore projects, which is a 10-year time frame. Last 3 years, FY23 to 25, we've already given the acceptance of necessity worth about 9.5 lakh crores. So obviously these will sort of get converted to orders. If you look at recently, FY25, the ordering has been about 2 lakh crore. Prior to that, a year before, it was about 1.08 lakh crore. So it has already doubled. And I think the overall sense is that about 4 lakh crore of order has been given. And next 2 3 years, overall sense is that you will see an ordering of about 8 to 10 lakh odd crores. And export also is expected to look good. So this is one sector where you are going to see a pretty high teen kind of a growth across. And when you sort of look at the order book, I think most of the stocks will have 5 to 6 times of FY25 book in terms of orders. So there is no issue with that, and which is why we feel that the private sector participation also needs to go there. So be it HAL, Bharat Electronics, Mazagon, Cochin Shipyard, Midhani, Astra Micro, Data Patterns, and Solar. So these are the companies which you have been liking. Any kind of a correction, since these stocks have rallied, is a good buying opportunity according to us. This week we had seen some numbers. So for example, HAL numbers were flattish, largely on expected lines because provisional numbers come out. But the point to highlight is that this company has got orders worth about 1.84 lakh crores, which is 6 times FY25 revenues. On top of it, there's an expectation that they could get an order of about 65,000 odd crore for 97 Tejas Mark 1A. And I think Indian deliveries have started, so we will see, or our sense is that numbers or execution will keep getting better. Similarly, Cochin Shipyard, again, they've got good order book. The the ship repair portion, which is a high margin business, is shaping up well, now contributing about 40 odd percent. Plus, on top of it, this is one of the few companies which can build aircraft carriers. And on top of it, besides defense, on the commercial side, also things are looking quite constructive. So I think whatever could go right for defense is going right.
Absolutely. So let's move on to the results this week. Maybe let's start with auto sector. We had Tata Motors and Eicher Motors coming up with results. How did they look?
So Tata Motors again, see the challenge with Tata Motors that it's very difficult for the management to give a call because of the uncertainty around tariff. But there's some positives. So for example, the US UK trade deal has happened. So UK can export 1 lakh units of JLR to US at 10% duty, whereas this was somewhere about 27.5%. But again, there is a slight glitch that some of their models are produced in Slovakia, which, say, for example, Defender. So that will attract 27.5% kind of a good. Otherwise, domestic JLR margins have been sort of okay or slightly better. Domestic CV business again stable, PV business again sort of okay. This quarter, at least the company has turned net cash positive if I sort of exclude the NBFC sort of a segment. Now, the challenge for the company is in terms of guidance, so they're not finding it conducive to sort of guide. But our sense is that when we look at the valuation parameters, the JLR is valued at 2 times EBITDA, the domestic business is at about 10 times. Typically, for auto companies, we give even slightly higher than that. So I think the valuation looks quite comfortable to us. And any kind of a positive development is definitely good news for Tata Motors, which is why, according to us, it's a buy. Uh, Eicher Motors, good set of numbers because company has been driving volumes. So volume growth last quarter was about 24 odd percent. They're consistently clocking more than 80,000 kind of units. But yes, that is happening at the expense of a slight dip in margins. But why we are liking Royal Enfield is again the number of refreshes which are going to sort of launch. Plus, our sense is that with the income tax benefit kicking in, this is one of the two-wheelers which is expected to be a beneficiary. So from that perspective, we feel that the stock should do well again with a target price of 6350.
Absolutely. How about Tata Steel, sir?
So Tata Steel also is on a roll. So again, when you sort of look at from a quarter number, there's nothing major inspiring because revenues are down about 8 odd percent YOY basis, while the volumes are up about 4 odd percent. But then again, I think numbers overall looks off. But I think the good part is that the outlook from here on will keep getting better. The management has guided for about 3,000 rupees kind of a price hike. Then the domestic volume growth is expected to be better because Kalinganagar plant is expected to sort of come up. The other thing is that coking coal cost is also expected to be down. On top of it, company is driving cost efficiencies. So they're looking to pull down their cost by 11,500. So again, saving would be in Indian operation of about 4,000 odd crores, something similar in Netherlands, and around 3,000 in the UK operations. So if you sort of combine that, things will start looking a lot better for Tata Steel. And like I've said, steel is was one of the worst phases we have seen, and things are going to incrementally get better. And which is why I feel that while Tata Steel has done well, but there is still potential for the stock to sort of do well. According to us, the fair value should be around 200 rupees for the stock.
Absolutely. How about Shree Cement, sir?
So again, cement is another pack which is coming out with a pretty good set of numbers. She is the most efficient player of the lot. EBITDA per ton improved 30% quarter on quarter to about 1,400 odd rupees. There was positive surprise on the volume growth and also on the pricing side, we were positively surprised because 5% price growth in the northern region is definitely good. Volume was slightly down. But then again, I think our sense is that next 2 years, the company is been expanding capacity. So we are expecting about 8% kind of a volume growth. And since it is one of the most efficient players, we feel that this company is like a JSW Steel, what you see in the steel side. So again, good company. The upside may not be so high because it always stays at rich multiples. But this is one of the few portfolio stocks in the cement pack to sort of look at. Like the performance, and which is why we recommend a buy.
Absolutely. Cipla also came out with results, sir. How did that look?
So again, a lot of these pharma companies which you have sort of turned cautious, and Cipla is sort of no exception. So revenue grow high single digit, largely driven by emerging markets. US growth was flattish, while we are seeing decent amount of growth on the profit and bottom line because of the margin expansion. In fact, profit growth was pretty good at about 30 odd percent. But FY26 is expected to be soft, but I think company is going to do a lot better in FY27 because the company is building a very strong pipeline in the US market in niche areas of respiratory, anti-cancer, and peptides. So they've got about 10 to 15 odd launches starting from second half of the year onwards. And mind you, these are all high margin products, so which is where we feel that the momentum for this company should catch up from FY27 and beyond. And actually, the pricing growth happens prior to that. and they're changing some of the strategies. So, for example, Africa moving from B2B kind of a business to B2C. So our sense is that this company is pretty strong in the respiratory side, and with the kind of launches which is expected to happen from H2 onwards, stock should do well. So from that perspective, I think we have been liking this stock as well.
And finally, something that our audiences have been asking for week after week, again and again, the hidden gem. It's back after some pause. So, which will be the hidden gem for this week, sir?
So what I would like to recommend is Aditya Birla Real Estate. Now, this company, we have a target price of 2550, and this is a company which is a real estate arm of Aditya Birla Group. And they've got residential portfolios in the Mumbai region, NCR, Bengaluru, and Pune. And Worli itself comprises 50% of their GDP. Now, overall sense is that this company has done well. So in FY25, so they've got their bookings are up about 2x. The collections are up 2x this year, and the development also is gone up to about 25,000 odd crores in FY25. And management is guiding for about 23% CAGR kind of a growth in pre-sales till FY28. Given the fact that they're sitting on good amount of land bank, and so from that perspective, overall sense is that they've got a pretty good gross development value of about 50,000 odd crores, of which about 6,400 crore is sort of unsold inventory, and they have a GDV pending of about 46,000 odd crores. On top of it, debt is not an issue for a company like this because they'll be selling their paper business to ITC, and post that even the debt is also sort of going to come down. And on top of it, we've seen nearly 35% kind of a correction in the prices, and it's trading at closer to NAV. So our sense is that in real estate, see, it is extremely important how good the promoter is. So which is where I think there are no challenges there. Plus, the growth outlook is pretty good. And I think our sense is that the overall macros would also turn positive, since I already spoke about interest rates sort of coming down. And so our sense is that real estate is another sector we should do some catch up, and within that, Aditya Birla Real Estate looks as a prime candidate for that.
Great, sir. Well, that was it for this week. Thank you so much, Pankaj sir, for your insights. And thank you so much, everyone, for watching. If you have any questions, please do put them down in the comments and we'll try to get back to you.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.